So I did not make friends this morning with a woman on the way to the office who did something very annoying while I was in the car. And this is a pet peeve of mine. So I need you to help me bring this trend up to the masses. So I'm
Okay.
stopped at a stop sign and it's at a T, right? So I can't go straight. I can only go right or left. And in fact, there was a divider in the middle of the road, so I can only go right. So I'm at a stop sign, waiting to turn right. There's a woman coming from my left side towards me. And so I wait because she's driving and I don't want to crash. And at the last possible second, she decides I'm going to turn without putting on my turn blinker. I was like, come on. Like, I could have gone already 4 or 5 seconds ago if you just clicked your blinker up. I know how much effort does that take? She is not my friend. And I hate people like that.
Oof, strong. Okay, so I understand the
So
frustration.
I need to know that when your blinker is going to affect somebody, that you actually will use it.
Look, so here's what I'll tell you.
Yes, 9 out of 10 times I use my blinker. I'm sure 9 out of 10 times you use your blinker also. But what about that one time that you don't?
Well, I don't use it if no one's around me or if I'm making a left turn and someone else is like not going to be bothered by it, right? Like this, in this case, if someone's trying to get out and I'm going to be turning where they're coming from, I use my blinker so they know I'm going to turn. You don't have to wait for me.
Yeah. So look, I hear you, but here's what I've tried to do
It's
as I try
respect.
to, but wait a second, because how much emotional energy are you putting into this thing? It feels like too much.
It's just a click button, click the thing up, click it down, click
No, I
it.
get it's simple, but what if she usually does it? She just missed it that one time.
I don't feel like she could care less about me. She's selfish. That's what she is.
Oh, boom, you walked right into this. So it's interesting how the fatal attribution error comes to pass whenever we are looking at other people. Because like that happens, right? If you get cut off in traffic, immediately that person who cuts you off, character flaw, they are immoral person. They probably had a terrible childhood. They're gonna probably murder someone after they're done cutting me off.
They're probably the ones that leave the shopping cart in the middle of the aisle while they sit there looking around, blocking the entire aisle. Like, come on, think about others.
I get it. I've started to put my rose-colored glasses on when I'm given those situations so that I don't invest the emotional energy that comes from it.
Well, I'm not going to take out a handgun and go after this person or follow them.
That escalated
I just,
quickly. Ladies and
I
gentlemen,
just think
Listener, if you're there, don't cut Brett off. Use
the
use your blinkers.
I don't even have a gun, by the way, but the use of a blinker is not very, it feels like it's being used less and less. And I think it needs to be used more and more.
Well, no, I look, I'm very supportive of blinker use.
Thank you. That's all I asked.
Okay, good. Yeah. I have a shirt that says use your blinker.
Welcome to episode number 20 of Talk Your Charts. This is Brett Horowitz. I'm with Marcos Segura. Marcos, we got a great episode today. It's very important. Not only is it number 20, and that's significant because I think we're still friends. We still like each other after all the arguing and bickering.
I can't believe we made it to 20. This is excellent.
Yeah.
Listener, thank you for sticking with us.
It's like an 20th anniversary. It came very fast. But it's also important because we've got some big news to share with our viewers. This is something that you and I have not chatted about previously. The news is that Marcos, along with Catherine Soho and Brian Fisher and Roxanne Alexander, all became partners since our last Talk Your Chart.
Wow, thank you, Brett, for the
congratulations to Marcos. Look forward to working with you for a very long time.
Cheers, partner. Cheers.
So I wanted to start with an optimistic stat of the day. And this is one that I've shared with you and everybody else in the office. And it was something that was brought to my attention a few weeks ago. There have been 5 times, not including this year, where the S&P started the year down at least 15% in the first 6 months of the year. In those 5 situations, the market on average had a plus 24% return in the second half of the year.
Okay.
Now, when I say that to clients and I say it to everybody in the staff, everyone's just like, well, that's not going to happen this time. And I feel like I'm pretty sure that if you ask people in those 5 years, 1932, 1939, 1940, 1962, and 1970, the same question, they'd say, yeah, that's not going to happen.
Yeah.
The reality is 4 of those 5 years, we did end up negative, mostly by single digits. In 1 year, it was only by 0.5%. And I think people look at this and they just see all the negative headlines and they say, there's no way this will be a good second half. Just everything out there is so bad, right? I'm sure you hear it all the time.
Yeah, you do. I think the point you made is the one that I would have pointed to immediately is I bet you that's how everyone was feeling at the time also. And it's not to say that we're going to end up positive, right? Who knows? Look, we're human too. And I'll admit there's a lot going on. There's a lot of kind of downstream effects from the COVID stuff, from the monetary and fiscal policy stuff, from the supply chain stuff that who knows how it's all going to come together. But I think the point you're probably making is that the market is not going to disappear. And looking forward from this moment in time, you're probably going to get better returns. You just have to properly extend your time horizon.
Right. I mean, you look at it over the next month, 2 months, 3 months, who knows? And like I said, 4 of the 5 times market still ended up negative. It was single digits, so it wasn't so bad. But go ahead.
What were the 5 years?
1932, 1939, 1940, 1962, and 1970.
Got it. I don't remember all of those, but that was Great Depression and then inflation stuff on many of those.
Right.
Yeah. And it was pretty clear that the world, quote unquote, was coming to an end during the Great Depression.
Yeah. I mean, that was hopefully we never experience that again. And that was a lot of differences than there are today in terms of not having a Federal Reserve and doing what they do. And, just the world is very different than it was then.
Yeah. There was also no index funds. There was, I'm exaggerating, but there were 7 stocks to own, right, back then. And that was, you literally went to a bank, you got loans from a bank, and you went and bought one stock. And then all those banks borrowed money from other banks and just kept doing this over and over and over and over and over and over and over again. And then it all crashed. How weird. And then right. What happened with rates? All the policy responses governmentally were wrong. So it was just this horrible confluence of events. Plus, on top of all of that, there was a housing crisis. So yeah, that was it stinks to have been around then, but we got through it.
Well, I think the other difference, or you look at all these different years and you look at even 01, 01, 02, you look at 07, 08, every recession as we see it is very different. It happens for different reasons. It goes for a different length of time. It ends differently. The causes are different. And the chart that I've got here from that, thankfully, our friends at Vanguard sent us, shows basically the market over time over the last basically almost 10.
We're looking at growth of $100 here.
Yep.
Okay.
And the green sections that are shaded are all the recessions. And so if you look at it from a big perspective, it looks like a really nice chart of just over time making more and more money. Now, you don't see the rockiness of day to day, month to month, year to year. But if you were to look at all little green sections and zoom in, you would see that a lot of them, the first half of the green, the markets go down, and the second half of the green, the markets go back up.
Yeah.
And we've talked about it a lot in that the markets are forward looking and that we're hoping that a lot of the negativity is already priced into where the markets are today.
Yeah, so who knows? Like what could surprise the markets and what could not be priced in? What if the Federal Reserve increases interest rates instead of by 1% or 75 basis points, it's by 300 basis points or 3%. Those are the types of kind of outlier events. Odds are, if you, I mean the listener that we have and us and friends and everyone, if you're talking about it with people, the market has already most likely priced that in, because if you're aware of it, then you better believe that the entire market of participants in said market are also aware of it. And the other reality is every recession is different and all the circumstances are different. Are we even in a recession? Who knows? Everyone's talking about it's 2 quarters of GDP that are negative, right? So you get negative growth 2 quarters in a row. Got it. Here's what's interesting about that. Last time we had a recession, that didn't happen. We only had 1 quarter of negative GDP growth. It was during COVID, but they still called it a recession. Why? Because it's more of an unemployment thing, right? When the Bureau of Economic Analysis or the forgetting the name of the other organization, the National Bureau of Economic Research. When they call the recession, it's not just the negative GDP thing. It also has to be unemployment.
Well,
Are
I
we
think
seeing some of that go away? A little bit,
a
but
little.
not there yet.
Yeah, from what I read, there's lots of firms, and I'll talk about us in a second, but lots of firms where you've been understaffed, right? You go to almost every restaurant, there's a now hiring sign. So they have 10 servers where they should have 13 or 14. My hope and what would make me, what would sort of please me is if instead of we got this supply increased, if you had demand decrease a little bit, you don't need to fire anybody because you already don't have enough servers. But now you get to a point where you have enough servers to offset that demand, right? So many companies are closing down on Friday and Saturday to give their employees a day off because they're just overworked.
Yeah. So if you follow the traditional path, we mentioned a second ago, all the headlines are always different when these recessions or economically strenuous events happen. But the path that markets and economies takes is usually the very, very defined path of first markets fall, then earnings fall, then GDP falls, and then unemployment goes up, right? So employment falls. That's usually the path it all takes. And the recovery is the same thing. First, the market rises, then earnings, then GDP, and finally employment. And that's what usually is tricky for people, because if you follow that, that means, as we all know, because the market is forward looking, the market's going to start recovering before things get better.
Well, that's why I think this second chart to me was really surprising, very interesting. Basically, there's 4 different quadrants that you can see on the screen. And anything in the top left quadrant, this is comparing GDP growth and the return of stocks and bonds. So anything in the left quadrant is where GDP growth was negative and stocks outperform bonds, which there are a number of situations in there. It's not the majority, but it's not zero. And then in the bottom right quadrant, you have areas where GDP was positive, and yet bonds outperform stocks. And there's a lot of circles in there. So again, the most likely is in the top right, where GDP is positive and stocks outperform bonds, but it's not like it's all cases. And so you can't look at just GDP growth alone and say, okay, GDP is going down, therefore bonds will do better than stocks.
What period of time is that? Do we know?
This is probably going back, I don't know, long time.
Yeah. Okay. That's interesting. I mean,
It makes sense now that I finally understand it. Took me a second, sorry.
but yeah, that makes sense. Growth is good. Stocks do well.
Ultimately, the
Not
best part
always.
about that,
Not always. That's the point I'm trying to make.
no, exactly, but not always, but
Right.
probabilistically, the majority of the time, right? So yes, you have to go through periods like this, but the majority of the time you're going to be fine. So let me ask you this, Brett, on your chart, that's a growth of $100. When you're looking from 1926 to 2021, it's a long period of time. What if I don't have that long? What do you tell to the person who's like, you know what, I'm going to start living off what I've accumulated in 5 years, maybe less sometimes. How should I approach this?
Cut the chart into 5-year periods, 10-year periods, 20-year periods. It probably has the same shape, right? Like I know that I've got a longer time horizon than some other people, but I'm not trying to time when those green things happen, when those slight drops happen, because if I just stay in there for the entire period of time, I'm a lot calmer, I'm a lot less emotional, and I can just ride that out, because over time it just keeps going up and up and up.
Okay.
So I even less periods would be the same thing, shorter periods.
Yeah, I agree. I think you just, the one thing I would add to that is, this is when it usually makes sense to be kind of short-term pessimist, long-term optimist. And as you're getting closer and closer to that period of time when you're going to be living off what you've accumulated, well, that's when cash reserves and bonds are actually there to do something.
For sure.
So you can hate on bond returns all you want, and you can hate on cash burning a hole in your pocket, but good Lord, do they feel nice in moments like this, especially if you're getting close to the period of time when you need to start using it for whatever that is, right? For living expenses, for a down payment on whatever it is. So
yeah,
I think
Harold
that's when,
Levinsky's bucket strategy has been so instrumental over the years. So if anyone doesn't know what that is, let us know or read about it, because it just takes all the psychology and emotion and worry out of it for our clients, knowing they've got that bucket of cash there.
Exactly.
Bonds after that.
So I think this pivots perfectly to the chart that I have here from our buddies over at JP Morgan. And this is, look, I've been joking with people when I say, if you weren't a long-term investor in January, you are now, right? Obviously, markets are down 24% from the bottom. So in the chart that I'm pulling up here, if you look at the highlighted little date at the bottom, that's basically what's happened this year. We've seen a drawdown of 24% from the high that was reached on January 3rd, 2022. So forgetting about what's happened, and I don't think it's worth anyone's time saying, man, what if I sold on January 3rd, went to cash, rode it all the way down, found the bottom, then reinvested then? Wouldn't that be great? Of course it would be great, but let's just—
And there's a time machine. That would be terrific.
Yeah, and again, I always say it, if I knew how to do that, I wouldn't— actually, maybe I would be on this video because I like you a lot, but let's be honest, I wouldn't be, neither would you, because we'd be on an island somewhere, right? So moving forward, right, let's be productive adults about it. From today's point in time where we're down 24%, how long, Brett Horowitz, do you think it's going to take to get back to the market high that was achieved on January 3rd, 2022?
I'm not going to pick one of these years because I'll be wrong, but
Oh, no,
I think it's a fantastic chart.
Pick. No, you have to pick, man. That's what makes it fun. Pick. I'm going to hold you to it. Calendar invite.
1 year.
The worst one, but okay, fine. 1 year. So Brett, if you're right, what this chart is showing us is that if the market recovered a year from now, that means you would annualize a return in the market of just over 27%. That's excellent.
Sign me up. Sign me up. I'll take it.
Of course. Yeah. Like, what are you doing? You want to sell now? Because if you think it's going to recover in a year, you're going to be just fine. Now, I'm going to be more conservative than you, Brett. And I'm going to say, you know what? I think it's going to take 5 years for the market to get back to its high achieved on January 3rd of 2022. Well, guess what? In that very conservative assumption, where we get back to the high in 5 years, you're still going to average an over 6% return per year by staying the course. And you could even goose that up if you determine that right now is a good time to perhaps rebalance your portfolio and take advantage of lower prices. So your recovery might even be faster than that. So simply put, do your best as an investor to look forward and not backward.
Yeah, I don't know why people stress so much about when to enter in and when to buy in and when to put their money to
Because
work.
we're not robots, Brett Horowitz. That's why.
Well, look, it's a difference if you just, as I told the client yesterday, it's different if you just sold your company and all your net worth is in cash, and this is one decision: do I get in now or do I get in later? Like that, I get. For most of our clients, they already have lots of money already invested in the market. So when they're talking about adding money, making a deposit, the fact is, like you show here, you're not going to make 6.4% on average for the next 5 years if you keep your money in cash. And unless you can be perfect in that timing, it doesn't mean that if you wait 2 months and we're now down 26%, that you had it's a huge difference versus where you are today, down 24%.
Yeah, I agree. If we're talking about new dollars, like, so you're sitting in cash and that cash is meant to be invested, I mean, this is an opportunity, right? Is what it is. It's hard to appreciate that now. And the reality is this could go on for a lot longer. And this is also just looking at the S&P 500. I would not suggest, I don't think you would either, that you just put all your money in the S&P 500,
right?
Because we do know that lost decades happen. And unfortunately, the only way to do your best to avoid a lost decade is expressing humility. How do you express humility? You diversify, right? The D word, it's so boring. We know everyone hears it, but not everyone does it.
It's also odd that when you talk to clients that are saying, well, I've got some cash and I think I want to deposit it, I'm not sure it's the right time. If you were to then follow up and say, well, when was the last time you deposited cash? What was the market then? I don't think most of them would remember that date. I mean, you remember it for a few instances when you first invest. I invested today, it was down 5%. Man, that was bad timing. That goes away in a matter of weeks or months. fast forward years, and you haven't remembered when the last time you invested, what the market did right after that, right? Like it just goes away after time.
Prisoner of the moment, man. Prisoner of the moment.
So I think this is terrific in showing someone that like take your worst case scenario and it's still better than just sitting in cash for the next 5 years.
Yeah, I'll take not cash. Thank you.
For sure, especially because at least in that case, you're guaranteed a loss, right? You're guaranteed that inflation will beat cash over the next 5 years, right? Not many times where cash is paying higher than inflation.
Yeah, that's just a fact. Again, if you need the cash within the next 5 years for something, you may not want to invest that money. But if it's meant to be invested, it smells like an opportunity.
Well, I also think it's odd that when I ask clients who are going through this pain of the market, I say, well, they say, I'm really nervous about what's going on. And so I'll jokingly will ask, well, have you done anything differently? Are you spending less? Are you changing your habits? Are you, not traveling as much? No. Well, how worried are you? Right. I mean, it's the same reason that you and we've said before, don't eat lobster on the way up. We don't eat tuna fish on the way down. Right.
I eat both at all times. Absolutely. High protein. I'm in. So let me add to that though, because here's what's interesting. We do need inflation to slow down, right? That needs to happen. So all those people who perhaps say one thing or say something and then behave differently, we need people to stop spending. Look, inflation is going to stop because the Fed can, even though there's a big supply chain issue, the Fed can put us through so much pain with rates that eventually we stop consuming. And that's 70% of our economy.
Well,
so
you're
that's
already
going to
seeing
be
with housing, right? You're seeing housing prices stop,
I
come
get it.
down.
Look, the rent lags. Remember, the owner's equivalent rent, which is the housing expense and CPI, that lags. So there's probably 2 more months where that's for sure going to be increasing. So we'll see how that goes. But Volcker got rates up to 20% in the 70s, and suddenly inflation went down. I'm not saying that we're going to 20% in the Fed funds rate.
Better not.
Right. But here's what's interesting. Have you ever heard of the Taylor rule? The Taylor rule is that Fed chart that basically says, here's what the equilibrium federal funds rate should be. And right now it's about 5%. What are we at on the actual Fed funds rate? Between 1.5 and 1.75. I'm not saying we're going to 5, but there's still a gap there. So how much pain do we have to go through, and how long will inflation continue to rise? Those are the questions that are unanswerable, but obviously very important.
We will get more answers within the next few weeks when the Fed meets again. And before
that's
the next
it. I think it's next week. Most important thing here, listener, Breck called the recovery 1 year from now. So
you're welcome on that 27.4% return.
Hey man, we can't be 5 years. I can't be waiting 5 years. Let's go faster than that.
I'm very patient. I'm being very patient, trying to work on my values. Patience is one of them.
Okay.
Horowitz, thank you, my man.
Seeing you. Have a good one.
See ya.
Bye.